family. So today we're going to be talking about one out of the four elements to a trade setup. We're going to be talking about consolidations. What is a consolidation? Is when price moves in a clear trading range and shows no willingness to significantly move higher or lower. It also indicates that the market makers are building orders. What are the orders? The orders are the retail traders' sell stops and buy stops, right? When the market goes into a sideways motion, it creates a level of support and a level of resistance. So for traders who like to hedge the markets, what do? In case of a loss, they place buy stops above the resistance and sell stops below the support. So since the market makers know that, they move to the side with the most buy stops or sell stops. So what are you going to see them do? You're going to see them expand out of the consolidation, which will be the false move. We don't chase price. You never chase price. You never chase price. We catch on the retracements of price, right? So once the market makers expand out of the side of the market with the most money, we then wait for them to show their face. When I say show their face, I mean we're looking for engulfing structures, which lets us know that they're implementing either sells or buys within the market, right? So if we see the market drive up 10 million, drive down 20 million, and then a flow of money will come down 40 million, right? So now they're in negative, right? Then they break structure to the downside. Now they're looking for another point of interest to capitalize on sell stops. The sell stops below the consolidation, and also the sell stops that are below the lows of the so-called trends that 95% of people trade, right? So once the market create a high and then a low within the markets, people place buy stops above that high and lows below that low, right? So just in case if they're thinking that we're still in the uptrend, this low should be respected, and if this low gets violated, they're going to be in profit because their sell stops will activate, right? So for us, what we call these engulfing structures, we call them order blocks. Once the market makers have collected enough buy stops and sell stops, right? They're going to create engulfing structures. They're going to place their positions in the markets, right? Leaving them in these so-called block of orders called order blocks, right? How do you trade an order block? We'll make another video or in the future, right? And I will show you guys how you trade those, right? But basically we have the entry, the open of an order block, we have the 50%, and then our stop losses go below the wicks. So basically when I say higher time frame support or resistance, it can either be an imbalance or order block, or it's different types of points of interest, right? ICT tools, right? God bless you, Michael J. Huddleston, right? Shout out to my boy, right? So there are different ICT tools that we can use to let us spot institutional points of interest, right? But also understanding the grab of liquidity, right? If you guys look here and you look at this Wyckoff distribution schematic, right, you can see how we go into a range, right? We're creating almost a support and resistance like structure, right? We have this low, we have this high, and then price does what? They run above, they break out of the consolidation, right? And then they start to sell. Once they break this support, now we're looking for sells. Now we get our change in market structure. Now we're looking to sell. All right, but basically all there is to it with this Wyckoff distribution, you're just looking for the U tag. We're looking for the grab of liquidity. That's it. We're looking for the fake move, the false rally or the false drop. All right, and if you look at the Wyckoff accumulation schematic as well, right, you guys see we have a range, then we have the last down drive that goes below the support and reverses, right? Now we can catch up on any imbalances or fair value gaps that are in these LPS and BUL. I don't even do this shit, so I don't even pay attention to Wyckoff, but understanding when the liquidity is grabbed is the most important thing, right? So you guys then see, right, the market makers would then come mitigate their shorts and then go lower, capitalizing on the buy stops above this old high, and also capitalizing the sell stops below this low from the bullish order block. It could be an imbalanced fair value gap as well. It's not always order blocks. Different ICT tools that you can use within these markets to be profitable. It's not just order blocks. All right. So now we're gonna look at a setup within these charts. Best way to backtest, right? You can use hindsight, live trading, or you can use the rewind tool on TradingView. It's only like $20 a month for it. I think $30 a month. Not too expensive, but if you want to up your trading, I suggest you either do hindsight, which is free, live trading, which is also free, or bar play rewind, right? So if you guys look at the daily here, you can clearly see that we have a range that the market is moving in. We have this support level that they're failing to break below. So once this support breaks, sell stops are going to be below here, right? This is another example I have over here. So we're going to bring this sell stops right here below consolidation, buy stops above resistance, right? So you guys see we have our last up candle before the down move in price. We have a resistance level here. We have buy stops above here. You guys see that we have this one drive up, right, into the order block, which then sells off, right? One good confirmation to use when trading order blocks is seeing prices, the bodies of the candles close below the open of the order block. You don't want to see it shift in and close, which is a bad sign that they might violate this order block, right? So this is a good sign, right? You guys can also see the accumulation schematic right here for Wyckoff. We have a support, we have the spring that drives down, we have the up move, right, which creates an order block, which you can then take your trade upon. Stop loss below the wick, entry at the open, 50% right here, right? Entry 2, entry 1, stop loss altogether. Just have a set risk, right? And then you can see you can take profit above this high. This was the previous day high right here, was above here, buy stops, and you can see the market maker sell off again, right? They need buyers to sell and they need sellers to buy. That's all there is to it. It's not that hard. It's very simple on how the institutions trade in the markets. Also, now we go to the other schematic here for a bullish setup. You guys can see we have this double bottom here, or inverted head and shoulders. Some funky shit is going on here, right? But I don't know. All I see is the retest of the neckline. People are buying. Now they're like, yeah, this should work. And now if prices was to break this low or break this double bottom, we should sell and there should be a breakout and we should be in profit. No, buddy. No. Right? We see a bullish engulfing right here, which comes and just fucks your day up. Now you want to go and hang yourself, right? Right, but as institutional traders, we understand that, so we can never ever lose. We do lose, but when we do lose, that means we're reading price wrong. The institutions never lose, so that means we should never lose. But it's all up to your perception of how you view price at the end of the day, right? So you guys can see, what do we have below the support? We have sell stops below the support. We have buy stops above this resistance now, right? Look, right here, resistance. People selling. Once this level breaks, people are gonna, buy stops are gonna trigger. They're gonna think it's a breakout to the upside. What does the market maker start to do? They start to sell off. Look at this trend line they creating what? Creating liquidity in the market. Everybody's selling this 1 touch, 2 touch, 3 touch, gone, right here, right? So after we see this mitigation, right, this is like what I like to call a what do I call it again? It's called I forgot what I called it, but basically it's when an order block creates another order block from mitigation, right? Oh yeah, chain event. That's what I call it, a chain event, right? So you guys can see once these sell stops are collected right now, the orders are now in this last down candle right here, which is what we call the breaker block. I'm gonna touch up on that in another video. But you guys can see support and resistance does work, but only when it's done institutionally, right? So now we have this support here that price is failing to break. What's causing this support to hold this last down candle before the up move? But retail traders never understand that, right? This is engineered liquidity, engineered support. This is real support, right? Because we understand the movement in price on what the institutions are doing. So basically, yeah, this is one of the easiest elements to a trade setup to look for in price. A consolidation. What's below it? Sell stops. What's above it? Buy stops. So you want to sell below, you want to sell above resistance, and you want to buy below support, right? So that's all for this video, guys. I will catch you guys in the next video on expansions on order blocks.